Good morning. You're watching Daybreak on Bloomberg Quint Live, and I'm Alex Matthew. First, the headlines this morning. Asian stocks are off to a positive start after U.S. markets witnessed their strongest day of trade in over 2 weeks. Oil prices are little changed after a 2.5% surge on Monday, recovering some of the 7% cuts that were seen on Friday. Low cost of capital will not only ensure competitiveness but also determine the stability of the system, according to Principal Economic Advisor Sanjeev Sanyal. That's a Bloomberg Quint exclusive. And from next financial year, large corporates are required to raise 25% of their borrowing from the corporate bond market, according to a new framework issued by market regulator SEBI. And finally, the new board of IL&FS has claimed that 2 of its subsidiaries have received over a dozen offers as part of their asset sale plan to pare debt. Let's quickly talk about the US markets now. US stocks closed higher on Monday as retail shares rallied on expectation of strong sales as shoppers went hunting for deals on Cyber Monday. Monday's moves come after stocks suffered their worst Thanksgiving week since 2011 as a sell-off in the once-loved technology stocks put traders into risk-off mode. Investors will now shift focus to the release of the minutes of the Federal Reserve's November policy on Thursday. During this recent sell-off, investors have been worried about the future of monetary policy. The Fed is expected to hike rates in December after tightening policy 3 times earlier this year. For the next year, the Fed is expected to hike rates 3 times. Politics will be another area of focus at the end of the week for investors. The G20 summit in Argentina kicks off, and also the Brexit is dominating headlines. The meetings of the world's most powerful leaders will bring together US President Donald Trump and Chinese President Xi Jinping at a time when there's intense tension or trade tension between these 2 countries. And speaking about that last issue, the issue of trade between China and the US, days before that meeting that I mentioned, the G20 summit, US President Donald Trump has said that he expects to move ahead with boosting tariff levels on $200 billion of Chinese goods to 25%, calling it highly unlikely that he would accept Beijing's request to hold off on the increase. Bloomberg's Joe Sobzik brings you all the details in this report.
Well, the president puts great stock in personal relationships and personal talks, and he's going to be meeting with Xi later this week at the G20 summit that begins in Argentina. However, he has been taking a tough line that's certainly going to color whatever talks they have. He's saying that the current tariffs now at 10% will rise up to 25% as scheduled on January 1st, despite China's request to hold off on that. He also threatened to impose additional tariffs on the rest of the Chinese goods that are not currently subject to duties. Now, that would include things like iPhones and laptops, goods that would hit U.S. consumers much more broadly than the current tariffs do. Trump told the Wall Street Journal that he believed that tariff, some level, perhaps 10%, wouldn't cause a great deal of backlash from U.S. consumers, and that if the negotiations don't make any sort of progress, he's ready to impose them on all Chinese goods beyond just those that have already got tariffs.
All right, so that's clearly going to be a big talking point for the remainder of this week. But for what the Asian markets are doing currently, let's go across to Sophie Kamruddin, who's joining us live from the Bloomberg studios in Hong Kong. Thanks so much for joining us, Sophie. Over to you.
Well, Alex, as you pointed out, these are the latest lines from the Wall Street Journal regarding Trump's comments on China's tariff rates. That is certainly a big talking point. So after the best gain for U.S. stocks in 2 weeks, we have U.S. equity futures sliding in the Asia session, and we are seeing a muted advance for Asian stocks this Tuesday, but signs of a good start to the U.S. holiday shopping season that is providing meager room for optimism. So Japanese stocks are extending gains for a 3rd session, and Aussie shares are climbing with tech and energy leading sectoral gains. But the Kospi is fluctuating in Seoul as slumping Korean consumer confidence may be denting sentiment ahead of the BOK's final policy decision of 2018 on Friday. And as Greater China markets get warmed up here in Hong Kong, the Hang Seng is resuming declines with real estate and energy the biggest drag, while stocks in Shanghai are opening higher after a 3-day drop. Back to you.
Thanks so much for that, Sophie. All right, let's talk about India now. Darshan Mehta is joining me now to tell you all about the trade setup for the day and also what to expect in the futures and options space from the cues that he's picking up. Darshan, well, strong US session, some, lower ticks that I can see in the Asian markets as of now. How are we looking in India?
Yeah, so I'm really surprised because the US markets ended stronger. The global cues are strong, but the SGX Nifty is indicating a 50-point downtick. The other factor is crude is above the $60 barrel per mark. Commodities are mixed, but it's really surprising that the SGX Nifty, after a very, very strong close yesterday, is indicating a 50-point downtick at this point of time. So that's what happened with the SGX Nifty. How did the ADRs pan out in trade? Most of them did well in trade. The ones that didn't were Vedanta, which was down 2%, given the fact that commodities across the world have seen a rout. Dr. Reddy's and Tata Motors were rather weak in trade. HDFC Bank, ICICI Bank and Wipro, all of them gaining in trade. How did we end up in trade? A big rally coming into trade yesterday, and we ended up almost 100 points on the Nifty, but it was evident that it was the Nifty 50 that outperformed the broader market. So the mid cap was flat in trade, the small cap was down in trade. Again, banks led the rally. The Nifty Bank was up almost 1.5%. PSU banks also came to the party. It was up almost 0.8%. Two sectors that managed to do well. FMCG index was up almost 2.3%, with the likes of ITC and HUL leading the rally. And surprisingly, the Nifty IT index bounced back after going below the 200 DMA in trade yesterday. So yesterday, Tech Mahindra, TCS were below the 200 DMA, managed to bounce back. FIs, DIs, both of them were net buyers in the cash market yesterday. How did the Nifty manage to hold up? The Nifty was up 100 points. Basically, FMCG, IT, and consumption names did well. So HDFC Bank was the biggest contributor, contributed 23 points. HUL-ITC from the FMCG space, and TCS leading the rally. What didn't do well was Yes Bank, Sun Pharma, ONGC, and Coal India. Not the heaviest of the weights on the index, and that's why didn't have too much of an impact that time around. How did the commodity market pan out in trade? Again, crude is above the $60 barrel per mark. This is the Brent crude, which has just managed to open with a slight negative bias. Remember, overnight we saw a surge of almost over 2% on crude. Base metals, again, not the best of close for the base metals on the LME. Aluminium was flat in trade, but again there was selling pressure in copper, zinc, nickel, lead and tin. All of them, in fact tin was up, but the others saw selling that came in. Again, if you're looking at what's happening in China, zinc is down almost over 1%, copper is down almost 0.5%. Steel rebar has managed to hold on because the gap down over the past few days has been very, very high. As far as the F&O market is concerned, the Nifty was up almost 100 points. Let's look at what happened. Short covering was seen on the Nifty futures, about the 10,600 mark in trade. Fresh buying was seen on the Nifty Bank futures. Open interest build up of 13%, that too on the long side. Now, where are positions being taken? We are close to the 10,600 mark in trade. Yesterday at 10,500 and 10,000, what we are seeing is that put writers are active at 10,500 and 10,600, and 10,600 to high level is where call writers are much more aggressive in trade. What happened in trade yesterday? Since the market managed to rally, call writers shed positions and put writers started adding positions, and probably today some bit of unwinding may be seen, since the Nifty, SGX Nifty is showing a slightly weakish outlook. Shocks are there in the F&O band. There are no changes. The four remain: Adani Enterprises, Adani Power, Jet Airways, as well as Dewan Housing. Let's pull up the PCR to see what exactly happened. The Nifty PCR is at 1.64 from 1.46 since the market rallied. The Nifty Bank PCR again above the 1 level mark in trade. Counters which saw high open interest build up. You had your cement counters, ACC, which saw fresh shorts, Indian Oil, which saw fresh shorts, while fresh buying was seen in Axis Bank, Bata, as well as Asian Paints. Crude impact definitely having its way on Asian Paints. And terms where there was short covering or long unwinding, Pidilite open interest was down 50%. A little bit of long unwinding was seen. Short covering was seen in Power Grid as well as Tata Communication. Ramco Cements saw long unwinding, and Adani Power again above the 50 rupee mark saw short covering that came in.
Thanks so much for that, Darshan. Well, let's talk about what to expect now going forward. A lot has already been said on what to expect from the markets in the run-up to the 2019 elections, perhaps because of what the markets witnessed around 5 years ago in the run-up to the last elections. Now, what will it be like this time around, especially if the ruling party faces disappointment? We spoke to a host of experts, and this is what they had to say.
A lesson to be learned here is that when you have coalitions, the governments are far more responsible before they take decisions because their very survival is at stake. And therefore, you have much more responsible economic policy making than perhaps in a situation where one party holds absolute majority. It's not work for India. It's not work for anybody in the world. America had the best growth when you had the Republicans in the Congress and the Senate, and you had the Democrat president. I don't think it matters. I think what matters is most is how global scenarios work out, what happens to the people in power, and number three is what happens to institutions around us. You know, what happened to RBI, which fixes interest rates. Now, you can have the most stable government and the worst decision called demonetization being signed up by the RBI. So where does it leave a strong majority government versus a poor economic policy? It's the same thing. At the end of the day, the RBI, the CAG, the IRDA, the SEBI, the government all make some system or ecosystem where you come and perform and then you get the share price going. So I don't think that this election is going to make any difference to us or to the investment community. You are not even mentioned in the manifesto. So I think to say that you are important for them, I think it's overemphasizing you.
It's really very short term and more of an impact on sentiment than hard facts on the ground as such. So obviously, from our perspective, the state elections might give an indication of what's going to happen next year, but we wouldn't put too much weight onto that. But clearly, having, if you just look at an example of a government which doesn't have a majority, which it has a weak and unstable coalition partner, you just have to look at the UK and the political chaos that we're currently going through. So I think some sort of reasonably strong government in the centre is important, but of course I would agree that what stripe it is not our concern, as long as we see consistent policy making, and actually those are the factors we tend to look at.
Now, the market regulator has notified norms making it mandatory for large corporates to raise at least 25% of their long-term borrowings from next year onwards from the corporate bond market. And the rules come into effect, as I said, from next financial year. For more details on what constitutes a large corporate, here's a report by Sajid Mangat.
Market regulator SEBI has come out with rules for raising of borrowings from the debt market. The regulator has classified companies which have borrowings of more than 100 crores as large entities. This borrowing classification excludes ECB and intercorporate borrowings between parent and subsidiaries. The guidelines will be effective from 1st April of 2019 for companies whose financial year ends on March 31st, and from 1st January 2024 companies whose financial year ends on December 31st. Companies will have to borrow at least 25% of the incremental borrowing from the debt markets. If in case they don't meet this guideline for 2 consecutive years, there is a provision of a monetary penalty of 0.2% of the shortfall, which they will have to pay to the stock exchanges, and the stock exchanges will have to deposit it with SEBI's Investor Protection and Education Fund.
All right, now snapping its 7-day streak, the rupee on Monday fell by 18 paise to close at 70.87 against the US dollar amid softening crude oil prices. That, of course, has to be watched today. The domestic currency has now gained about 220 paise in the last 7 trading sessions. Moreover, weakness in the rupee against the dollar also weighed on bond prices. The 10-year benchmark bond closed at 96.4 rupees against 96.5 rupees on Thursday. Remember, the Indian financial markets were shut on Friday on account of Guru Nanak Jayanti. The dollar index, which measures the greenback against 6 major peers, fell as much as 0.1% during Monday's session. Other Asian currencies gained slightly in a thin trade on Monday as risk sentiment remained fragile ahead of this week's G20 summit that we've already spoken about, with investors focused on developments in Sino-US trade talks. Indonesia, a major net importer of oil, saw its rupiah firming as much as 0.2%. The Chinese yuan and Singapore dollar gained by as much as 1% each, while the Philippine peso and the Korean won edged up by 0.2%. The Thai baht, however, dipped as much as 0.1%. On to a Bloomberg Quint exclusive now. Capital needs to be made available to SMEs at a reasonable rate of interest, according to Principal Economic Advisor Sanjeev Sanyal. Speaking to my colleague Ira Dugal, Sanyal said that the SMEs have to be given the benefits of going through disruptions like the GST. Listen in to a slice of that conversation.
There are various issues. First of all is that the channels of credit to the SME sector, first because of the banking sector slowing down credit, and now more recently with the NBFC sector. So there is a channel issue. But even more perhaps problematic has been the fact that credit, when it does reach, is very, very expensive. So in the last several years, you've seen structural inflation decline for 8 to 10% range to now for the 4% range. In fact, sometime right now running even lower. So when you have reduced structural inflation by 600, 700 basis points, then you have to think about the fact of what happened to the lending rate. But on the other hand, SMEs are still borrowing at between 10 and 12%. Now, if you're borrowing at 12% and pricing power in the system is growing only at 4%, that is a 800 basis point real interest rate. So we have to understand that at 800 basis point real interest rate is very, very expensive for anybody. And so this is an issue that we now need to, as a country, not just the central bank or the MOF, but as a country, we need to think about the cost of capital, because in the end, the cost of capital does feed through to not just competitiveness of our manufacturing, but also to the sustainability and stress of the system. Conventional economists tend to only look at the demand impact of interest rates, whereas interest rates also have a supply side impact, they have a risk impact on the financial system. So all of these are issues we need to think about. So making cheaper capital available where it is needed for the SME sector is an absolutely critical thing that we need to think about.
Let me ask you for a view on whether you think a forbearance for SME restructuring would be advisable.
See, there are many things we need to do. So one of the things that, there is a short-term issue about monetary policy, about the current institutions that exist, and there is the larger issue of credit delivery to this sector at a time where we have indeed carried down this massive structural shift in inflation pressures in the system, and also in, dramatic tightening in the last few years of our credit institutions and so on. So, the fact is that we need to get institutional support, make sure the credit reaches where it does at a price that is reasonable to this sector. We cannot just have the same format we had before. So it's a sector that did go through some disruption as a result of many changes that happened, including introduction of GST and so on. And so now the time has come that we are on the end of this cycle, that we then support this sector and give them the benefits of going through all this disruption and change. After all, what was the purpose for everybody to lower inflation? So that we can lower interest rates as well. Now we need to take step 2.
All right, and well, it's a long conversation. You can watch all of the details on the website bloombergquint.com. Let's also talk about IL&FS. Now, the new IL&FS board has claimed that it has received over a dozen offers for 2 of its subsidiaries that it put on the block. The strong response has given it confidence to launch the sale process of many other assets as part of its ongoing resolution. Riddhima Saxena has this report.
The new board at the Infrastructure Leasing and Financial Services, which is chaired by banker Uday Kotak, has claimed that it got over a dozen expressions of interest from banks, private equity firms and other financial services companies to buy stake in its 2 subsidiaries, IL&FS Securities Services and ISSL Settlement and Transaction Services, that offer clearing services for equity and commodity derivatives. The qualifying bidders will now be invited to review information on business and submit commercial bids based on that. any binding transaction for the sale of assets as well as any resulting resolution plan, according to a press statement issued by the company, will require prior approval of the National Company Law Tribunal. Remember, in July, IndusInd Bank had backed out of a buyout deal for IL&FS Securities Services as the group defaulted on debt payments multiple times, sparking fears of contagion in the financial markets.
All right, let's take you through all the stocks that you have to watch out for in trade today. Yash Upadhyay is now joining me to tell you all about the stocks in news. Good morning, Yash. What are you picking up this morning?
Good morning, Alex. Let me first start off with GIC Housing Finance, and they came out with their Q2 numbers, and a bad set of numbers at that. Their net interest income, that fell by about 5% to 89.8 crore rupees for the quarter, whereas the net profit fell by about 1% to 46 crore rupees. Sun Pharma will be in focus as well after the company said that it has acquired Polar Pharma of Japan for an all-cash deal worth $1 million. The transaction is expected to be completed by January 31st of next year. In a separate announcement, they also mentioned that they have settled an ongoing litigation with respect to one of its drugs. The terms of the settlement were not disclosed. IFCI, that one will also be in focus in today's day of trade after the company said that it has received 492 crore rupees towards the resolution of Binani cement issue. Now Bharat Ventures, there the company has informed the exchanges that it, along with its subsidiary, has received supply orders from Tata Power Trading for power supply of 25 megawatts and 100 megawatts at a price of about 5.75 rupees per unit. Also, Sunil Agro, a small company, there has a market cap of under 100 crore rupees. That one came out with an announcement saying that it has started commercial production at one of its expanded capacities. And lastly, Future Group stocks, they would also be in focus on the back of an ET report that online retail giant Amazon is in talks with the company to buy out the latter over the long term.
Thanks so much for that, Yash. Well, those are the stocks that you have to watch out for. If you missed any one of them or a few of them, you can log on to the website bloombergquint.com and search for stocks in news. You'll get the entire list. All right, let's tell you about the big international story, corporate news, in fact, coming in from the US. US President Donald Trump has blasted General Motors' plans to lay off 14,700 factory and white-collar workers in North America and put 5 plants up for possible closure. He expressed public disappointment with moves by General Motors to shutter automobile production plants in Ohio and Michigan, telling the CEO of GM that the automaker must find a way to bring back jobs to the region, as Democrats have denounced the move as corporate greed at its worst. Listen in.
I was very tough. I spoke with her when I heard they were closing. And I said, you know, this country's done a lot for General Motors. You better get back in there soon. That's Ohio. And you better get back in there soon. So we have a lot of pressure on them. You have senators. You have a lot of other people, a lot of pressure. They say the Chevy Cruze is not selling well. I say, well, then get a car that is selling well and put it back in.
Now, that's clearly a very emotive issue. Jobs are at stake. But also, on the other hand, on the other end of the spectrum, investors seem to be quite happy about the announcement. In fact, we have more in this report by Keith Norton. He has more to tell you.
GM had the worst capacity utilization among the U.S. players. They had about a million units of overcapacity. So addressing that certainly is necessary, and that's one of the things investors are reacting to. The other thing is GM is going to need billions and billions of dollars to prepare for its future, for the electric vehicles and the self-driving vehicles that are in its future, and that's part of what's behind today's announcements as well.
All right. Now, clearly, that's going to be a developing story, and we'll bring you the latest when we get it. But Somit Sarkar is joining me now to tell you all about the big brokerage calls for the day. Good morning, Somit. What are the calls that you have for us?
Good morning, Alex. And the big brokerage call today, first we have is a big note on metal space that Morgan Stanley has come out with. Now, they have come out with this note on metal space where they have not only cut target price for most of the stocks, but they have also changed the ratings for a few of them. Now, for Coal India, they have upgraded the rating to overweight from equal weight. For JSPL, they have downgraded the rating to equal weight from overweight, and for JSW Steel, they have downgraded the ratings to underweight from equal weight. Now, they have cut the target price on Coal India, JSPL, JSW Steel, Steel Authority of India, and on Vedanta. And for Hindalco, they have marginally hiked it, and for Hindalco also they have cut the target price 290 from 295. Now the brokerage sees that now the brokerage, that is Morgan Stanley, prefers stock with higher earnings visibility and strong balance sheet. Now going forward, the brokerage also says that the domestic steel demand would be at a risk, and the high leverage for the steel companies also is a near-term concern, and that's the reason it has downgraded most of the ratings for the steel companies. Second, we have is Bank of America Merrill Lynch on Reliance Industries. Now they have maintained their buy rating on the stock and have hiked the target price to 1430. Now according to the brokerage, in the last 5 years, heavy investments in consumer business have helped Reliance Industries transform from being an oil and gas conglomerate towards becoming India's everything company. With better than expected traction at Jio, Reliance appears to have crossed the tipping point in terms of consumer acceptability when it comes to the B2C front. Now the brokerage has raised the target price on Reliance as it now factors in upside from media, digital and better than expected performance for retail and telecom business.
All right, thanks so much for that, Somit. Well, there's clearly lots to talk about, and of course you'll find all the live market action right here on Bloomberg Quint Live, but there are also several stories on the website that you should consider reading, apart from of course the regular copies that are all you need to know and stocks to watch. First up, Bloomberg Quint has reported that the government may infuse around 42,000 crore rupees in banks by December 15th. This is the amount that remains from the 2.1 lakh crore rupee bank capitalization program that was announced last year. And ICRA has downgraded long-term ratings assigned to Shapoorji Pallonji's 18,500 crore rupee fund-based and non-fund-based bank facilities, citing muted sales and weak performance of its real estate business. The group's rating was lowered to AA from AA+ previously. Now, you've probably look like one of your parents or one of your family members because of genes, right? Have you heard of editing of genes? Apparently it's possible. Take a look.
I feel a strong responsibility that is not just to make it first, but also make it as example how to perform like this, consider morality of society, and consider its impact to the public.
Clearly a very sensitive issue and requiring of a lot more study. That's all we have for you on this edition of Daybreak, but up next is all you need to know, so do stay tuned. This is Bloomberg Quint.